All right. Today is Wednesday, June 28th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. And we begin with this. The stock market, as you might be aware of right now, is in a mania rally, which is, by the way, the best half for the NASDAQ 100 ever. So what happened? We were talking about a recession, inflation, the economy going down. Why would the stock market thrive under these conditions? Well, the answer to that is three things. We began the year with three promises that ignited excitement and optimism in the stock market. Number one, China reopening. Number two, hopes that we are reaching the end of quantitative tightening by central banks. Number three, the promise of AI. Now, the first promise, which is China reopening, has been already challenged. And the reason is we've been getting abysmal economic data from China. So right off the gate, if you recall, in the beginning of the year, the rally was more inclusive. We saw sectors such as energy, metals, industrials, international consumer brands rallying higher. But then when we got bad news from China, all of these sectors lagged behind. Now we have one of the three promises exposed as perhaps a false promise, but we still have two. The promise of the end of quantitative easing and the promise of AI. Well, today we got both of them challenged. Perhaps the biggest challenge year to date. Overnight, we got the news that we have the Biden administration now perhaps including AI chips in exports restrictions to China, which means that a huge potential for these chips to be sold to the largest consumer of chips in the world. This potential might be closed now. And if companies like NVIDIA, for example, cannot sell their chips, their AI chips to China, then the promise of AI is very limited, and it gets exposed as a false promise. And then, of course, today we got central banks in Portugal, Jerome Powell from the Federal Reserve, Andrew Bailey from the BOE, Christine Lagarde from the ECB, Ueda from the BOJ, all together. And with the exception of Ueda of the BOJ, of course, who's facing a different problem, which is how do we get inflation up? The other three is facing a problem of how do we get inflation down? And the promise of the end of quantitative easing that led this rally year to date is now being challenged, as all of these three central bankers today confirmed that they will raise rates higher. Inflation is still too high, and they're not done in the fight. And the problem is we're now seeing hints of reinflation in the economy. The Fed made a major mistake, which we're going to talk about in details in a minute, which is pausing. Why would they pause if they're going to hike later? Why? Sending false messages and mixed messages across the economy, and what we get right now is reinflation. We talked about home sales rebounding significantly higher. We talked about, here it is, mortgage demand all of a sudden moving higher. And we know that financial conditions are now loosening, increasing the possibility of reinflation in the economy. It's not just the Chicago Fed Financial Conditions Index. It's Bloomberg Financial Conditions Index. It's Goldman Sachs Index. All of them are showing loosening in financial conditions. Is it really a surprise that these central bankers are now feeling that they need to do more? And a lot of them are not even entertaining the possibility of reinflation, by the way. A lot of them believe that they have more to do because inflation as it is right now is unacceptably high. More on that in a minute, but we begin with Joe Biden. Of course, we know the struggles that the Joe B administration is facing right now with connecting with voters when it comes to the economic policy, what they call right now as Bidenomics. But it was a rough day for Joey B. He began by claiming that his uncle won a Purple Heart in World War II, and then proceeded to call UK Prime Minister Rishi Sunak as president. And on top of that, Joey B slipped twice, at least in the last 24 hours, by confusing the US war in Iraq with the Russian invasion of Ukraine. Take a look.
Why not engage with Russia in meaningful talks to try to de-escalate the whole situation in Ukraine? You're sending F-16, sir. Mr. President, weakened by what happened in Russia.
To what extent has Vladimir Putin been weakened by recent events? It's hard to tell, but he's clearly losing the war in Iraq. He's losing the war at home. And he has become a bit of a pariah around the world. And it's not just NATO. It's not just the European Union. It's Japan. It's 40 nations.
And the reason behind the speech today is, well, the headline reads, just 34% approve of Biden's handling of the economy as he hits the road to talk up Bidenomics. I'm sorry, take a look.
Dick said, With this help, we created 13.4 million new jobs. More jobs in 2 years than any president has ever made in 4 and 2.
Yeah, 4 or 2, Jack, I don't know. You know why? Because it's a lie. They keep circulating that on Twitter over and over and over again. It's brainwashing propaganda. He's counting in, when he says 13 million jobs, he's counting in all of these leisure and hospitality jobs that we lost in the pandemic lockdowns and we just regained because of reopening. That's all. Now, the Biden administration's record on job creation is not that bad. They created a lot of jobs, but it's not 13 million. But again, this is what politicians do. And of course, Twitter under Elon Musk. Where is the fact checking? Anyways.
And folks, it's no accident. That's Bidenomics in action. Bidenomics is about building an economy from the middle out and the bottom up, not the top down.
Okay, from the bottom up, not the top down, but the majority of benefit in the economy is in the stock market, the oligarchy, the C-suite class. Those are the folks getting richer. The poor, the middle class, are getting killed by inflation. Housing affordability is the worst it's ever been in this country. Is that really bottom up, or is it trickle down again? Continuing.
We used to invest 2% of our gross domestic product in research and development. By the time I came to office, that was down to 0.7%. We used to be number 1 in the world in research and development. That's what we're known for. Now we rank number 9 in the world. China decades ago was number 8 in the world. Now it's number 2 in the world. And other nations are closing in fast. We used to have the best infrastructure in the world, roads, bridges, etc. But then we fell to rated 13th best
So I actually happen to agree with Joy B here. I think we're not spending enough on R&D, and the reason is companies, these big technology companies, they're using the cash for share buybacks. They're using the cash to pump stocks higher so they can cash out and they get richer individually. No regard at all to the company, no regard at all to the health of the economy and the future of this country. These companies supposed to be leading China in R&D spending, but they're not, because they're spending billions and billions of dollars in stock buybacks, in pump and dump schemes. What is the Joe Biden administration doing about that? Haven't heard the plan yet. But of course, the most dangerous assumption by Joey B today is declaring that there is no recession. The recession is not going to happen. Take a look.
President Biden touted his administration's economic policies during a speech today in Chicago. He framed his agenda as a break from Republicans' approach to economic policy. This pitch comes as the president is quite evidently ramping up his re-election campaign. One problem? Recent CBS News polling finds a majority of Americans think the condition of the economy is bad, much worse than the president described today in Chicago. For more on this, Ed O'Keefe and Robert Costa join us now. Ed, as you well know, is CBS News' senior White House and political correspondent. Robert is CBS News' chief election and campaign correspondent. Ed, I want to start with you. We heard in the open of the show the president, before he got to Chicago, confidently saying there's not going to be a recession. That seemed to me to be among the most important things the president said, not just about the economy now, but where he thinks it's heading.
Now, this is a really dangerous statement from the President of the United States. You're telling the population, hey, rest assured, no recession is going to happen, when you got the most reliable indicator in predicting past recessions. The yield curve inversion says we're going to have a recession. The Federal Reserve, your own Fed, says we have about 70% chance of a recession coming. But again, Biden and Powell agree that we're not going to have a recession. Wait till you hear Powell. Anyways, here's the problem for Biden. Only 35% of voters approve, 62% disapprove. And the most disturbing part is when we look at very strongly, a lot of people feel that way, not just in Republicans or conservatives. 44% of men, the majority, when you look at the groups individually, not strongly in approval or very strongly in approving. The most predominant group is those who say very strongly disapprove. Same goes with women, white voters, Hispanic voters, even among the youth, 18 to 29, 34% say very strongly disapprove. So Biden has a major problem here. What is the source of this problem? Here it is. When we ask voters what is the top the number one priority for you? And the answer is inflation. 65% say it is inflation. The majority of Democrats, the majority of Republicans agree that inflation is a problem. Matter of fact, when we ask inflation, very big problem, moderately a big problem, small problem, not a problem at all. 65% of voters say a very big problem. Now, you heard the speech today. I don't have to play that for you. He barely brushed on inflation, and he said, when he talked about inflation, he just brought up the fact that inflation used to be 9%, now it's down to 4%. Well, that doesn't do shit for the average voter. If you go to the grocery store, I don't care what number you give me, 9% to 4% to 0%, I'm paying more. And I know I'm paying more. My landlord is not going to come out and reduce my rent. I'm locked in. I'm going to pay more until my contract is over, maybe even more. My utility bills are sky high. My insurance cost is insane. My auto payment is out of whack. This is the problem with the disconnect. They keep touting the achievements or lack thereof, but they never really address the issue honestly. Hey folks, we know inflation is still a problem. Sure, the record says 9 dropped from 9 to 4%, but you're not feeling it, aren't you? So easy, folks. Play politics. Connect with the voters. Be the man of the people. But again, they'd rather gaslighting us, brainwashing us, and say, oh, inflation is not a problem anymore. And when they say the economy is stupid when it comes to elections and all of that, well, it is the number one issue. And voters give Republicans higher marks by about 12 points margin than the Democrats on this issue, even though the Republicans don't really have a plan. Their plan is more tax cuts for the rich. So why aren't the Democrats addressing this issue honestly? Here it is. I said if Team Biden wants to connect with voters, they need to speak from the perspective of the U.S. consumer. We're still locked in on rents, grocery, and utility bills that are double digits higher than pre-pandemic, while our wages grew by single digits. The quality of life is worse, and that's what it's all about. And by the way, what happened to the $200 billion that went missing from the Thing relief program? Oh yeah, maybe it's going to be found in Ukraine somehow, but anyways, we're just missing $200 billion here, folks. No biggie. And then we have to talk about fiscal responsibility and all of that. Anyways, let's talk about the central bankers. They came out today, higher for longer, forget about cuts, forget about what not done. And we know why. They can't say they're done because inflation is in charge. They're not in charge. Chairman Volcker was in charge. Chairman Powell, not in charge. So they have to be data dependent, quote unquote. This is the most dangerous aspect about this. They're going to keep chasing inflation. Inflation goes down, they back off. Inflation comes back, they have to raise rates again. And the longer this game extends, the more damage the economy will have to endure. And the higher rates will have to go for longer. Anyhow, it was a unanimous message today from all of these bankers saying we have raised, we're going to raise again, and if data merits, we keep raising, higher for longer. Get these promises of interest rate cuts out of your head. That's only going to happen if we have a disaster. Here's ECB's Madame Lagarde once again reiterating that the job is not done and more hikes are to come.
See inflation moderate from these levels, because we've already seen a nice moderation, for you to feel comfortable taking a pause or potentially going the other way?
Well, this is not what we're considering at the moment, okay? But if I look back at what we've covered, inflation was, I think the highest reading we had was 10.3. We are now at 6.1 headline. Core has moved a bit down, but we are really looking at both headlines, which is the measurement that we have agreed in our strategy and that is visible for people, for the consumers of Europe, but we're also looking at underlying inflation. And on that front, we are not seeing enough tangible evidence of the fact that underlying inflation, particularly the domestic prices, are stabilizing and moving down. So we're looking at as many measurements as we can, because we want to be in sufficiently restrictive territory for long enough so that we are confident that we reach our 2% medium-term target. And we still have ground to cover. And I think that, as I said earlier on, we are data dependent. We will decide on a meeting-by-meeting basis, but we know that we have ground to cover. And if our baseline stands, then we also know that we will very likely hike again in July.
And of course, we have Bank of England, Bailey. We talked about how the Bank of England is way behind the curve right now, and they have to do more. And the British economy will pretty much, it's in the bag now, will suffer a severe recession because rates will go higher for longer, and the economy is already damaged. even though Governor Bailey says that the UK economy proved to be more resilient than we have anticipated. Take a look.
Raising interest rates by 50, you did a double. Why did you feel the need to do that?
Well, it really picks up on the theme that Christine has just developed. First of all, I mean, the UK economy has turned out to be much more resilient, and that's a good thing. I mean, there's many good aspects to that. But what goes with that resilience is signs of a very tight labour market, which is showing through in pay awards, but also showing through, I mean, we've got an unemployment rate of 3.8%, which is historically right at the low end. So that resilience is coming through that way. But when we looked at again, to Christine's point, when we looked at the data, because we too are being driven by evidence at the moment, the cumulative data, both particularly on the labour market and on the inflation release we had, which to us showed clear signs of persistence, caused us to conclude that we had to make really quite a strong move at that point. It was justified. My own view on that was, if we were really of the view that we were going to do 25 and then we were really sort of baked in for another 25 based on the evidence we'd seen, it was better to do the 50.
So again, when these central bankers talk about economies being resilient, they're talking about inflation being resilient. They're talking about the inflationary sources being resilient. But consumers across all of these countries are barely hanging by a thread. They're using credit cards, they're living on debt, and the moment they lose their jobs and their incomes, it's going to be a disaster. But the most important question to Bailey was, why the 50? And he says, if we're going to go 25 and then 25, meaning he knows he has to do more because he's way behind the curve. But if we're going to do 25, then 25, might as well do the 50 right off the gate. And I agree. And that brings us to Chairman Powell. Chairman Powell made a skip or a pause, but then he says, oh, we have 2 more coming. And the question becomes, why not just doing them right now? If you say we have 50 coming, do it now. Why the skip? Why the pause? Why split the hikes into 2 meetings? Here's Chairman Powell.
Chair Powell, you've said it many times, and yet you paused, but you're not calling it a pause, and you're not calling it a skip. So what are we calling it?
Well, first of all, Sarah, thank you, and Christine, thanks for hosting us here in Sintra. So what we're calling it is maintaining the level of the federal funds rate at its current level for this meeting. Thank you. Thank you.
Buddy, they're laughing at you. They're not laughing at your joke. They're laughing at you. You're a clown. That's why they're laughing. And of course, when asked why the pause, he says, oh, we're just keeping rates as is right now. But then he went on and said, look, it's the natural evolution of our policy. So we went from 75 to 50 to 25, and now we're doing 25, pause, then 25. It's just the natural evolution of our policy. Speed, he calls it. Okay. And then he contradicts himself right away. Take a look.
Hikes. So this is really just a continuation. We're going to move the decisions a little bit, make them a little bit more time in between them, in an effort to get more information from the data to see how much restraint is really coming from these, through the pipeline from rate hikes that we only made now, in many cases, 6, 8, 9 months ago. So that's why we did it.
So maybe in every other meeting hike.
We've not decided that. So the only thing we decided was not to raise rates at the June meeting. We have not made a decision to go to that. It may work out that way. It may not work out that way, but I wouldn't take, moving at consecutive meetings off the table at all.
So we spent all of that time, and I cut it for you because it's too long, saying, oh, it's the natural evolution of the policy to go 25, pause, 25, reassess, then do it again. But then he says, oh, but I'm not taking the possibility of 2 consecutive rate hikes off the table. That could happen too. So what happened to the natural evolution of the policy? What are they hiding here? I'll give you a hint. It was a truce by the Fed. They were about to go to war. And some Fed members said, you know what? If you raise Mr. Powell, it's not going to be a unanimous decision. And the media will know that some of us decided to dissent. And of course, Chairman Powell, he wants to protect the reputation of the Fed. Because, the Fed has a whistle-clean type of reputation. It's not like Fed presidents got caught insider trading or anything. So unanimous is really important to him. So they made a truce. We pause now. Then we're going to resume hiking based on the data. And folks, when we look back at this, we're all going to realize that this was one of Powell's biggest mistakes, the stupid pause. And then, of course, Powell joins Biden. This is the Biden-Powell economic regime, Bidenomics, Powellnomics, which is basically gaslighting, denying stuff. And now even Powell says, yeah, I don't see a recession happening. Take a look.
There seems to be a path still for labor market conditions to soften and for demand and supply to get back into balance without the kind of large job losses that have happened in many prior cycles. And the reason for that is the level of job openings that still exist in the labor market. So it's still set 1.7 job openings for every person who counts as unemployed. That has been coming down. Actually, the number of job openings has come down now by almost 2 million. And what you're seeing is wage pressures. They're still high, but they're definitely coming down. You're seeing surveys of workers and businesses suggest that the labor market is not as tight as it was a year or two ago. So you're seeing a job creation is beginning to come down. There are a number of indicia that would suggest that we're getting the softening that we need. We're getting it slower than we'd expected, but nonetheless it's happening. So it's still a possibility there. But it's so uncertain right now. In my view, the least unlikely case is that we do find our way to better balance without a really severe downturn. I think there's a significant probability that there will be a downturn as well, though. But it's not to me the most likely case.
That's the hard landing scenario.
Or just this, I wasn't even thinking of hard landing. I was thinking of even a recession.
So Chairman Powell says we're not going to have a recession because we have a bunch of job openings on Indeed.com. I see that every day. I don't think we're going to have a recession if we have a lot of jobs open on Indeed.com. Meanwhile, his own Fed says we have 70% chance of a recession. Every time the yield curve inverted that way, we got a recession. But of course, Powell denies. He joins Biden. What recession? What are we talking about here? Then he goes on and says, but markets tend to move ahead of policy. Markets tend to anticipate policy and predict that correctly. And it moves before policy. Take a look.
I would just say again, so what's different this time is actually, though, that markets move substantially in anticipation of moves. So by the time we lifted off in March of 2022, the 2-year had moved from 20 basis points up to 200 basis points. So financial conditions now move in expectation, and the whole modern communication strategy really helps that along. So that is different. What may or may not be different, and we also haven't had this kind of tightening in 3 decades, really. We've had tightening, but it wasn't. This looks more like tightening cycles from the 70s and 80s.
Well, if that's true, look at what happened recently to the 1-year yield. To the 2-year yield. They're all moving back to the highs, the same levels where we got the collapse of Silicon Valley Bank. So if the market is moving in anticipation of policy, and they're often right than wrong, then what is the message from the bond market here? Rates will go higher. Rates will go higher for longer. Why would rates go higher for longer? The answer is re-inflation. And of course, we have to talk about the BOJ Ueda because he's looking around and he's like, yeah, that's not my problem. I got a different problem entirely. But he made an interesting comment about the Japanese yen. Let's take a listen here.
And as a result of your policy being different than all these policies of your colleagues, the yen has gotten very weak and continues to weaken by the minute. Is it too weak?
Well, the yen is being influenced by many factors other than our monetary policy, including the policies of these 3 banks. So we'll see. We monitor the situation very carefully.
Monitoring the situation?
Yes.
For intervention purposes?
No, it's the jurisdiction of the Ministry of Finance. Decisions on intervention.
So in a nutshell, he recognized that when the BOE, the ECB, the Fed, if they come out aggressive and they have an inflation problem, they have to go higher for longer. This will add pressure on the Japanese yen, because the BOJ is loosening policy, not tightening. Now the question becomes, and he avoided the question altogether. He said, the manipulation of the currency, that's the job of the Ministry of Finance. But he has the tools. The BOJ has the tools if the yen drops too much to revive the value of the yen. How are they going to do that? By raising rates higher, by taking a hawkish stance. And of course, the problem is that these central bankers, it sounds like they're in synchrony, but they're not going to be if we have a currency war. If the ECB and the BOE have more to do than the Fed, more likely than not, they're going to add pressure on the dollar. And if the dollar goes down, the value of commodities will reinflate, and that's inflationary for everybody. Now, if the Fed goes aggressive and we see the value of the euro and the value of the British pound collapsing, then the purchasing power for these citizens will go down. That's also inflationary, because your money now buys less. And this is a problem that Japan is facing now. Sure, the official rate of inflation is about 2%, a little below, so they don't have to be hawkish now. They can afford to continue loosening the monetary policy. Until, of course, they realize that the drop in the yen is inflationary because it's going to cost citizens more to buy for stuff. At some point, they're going to have to raise rates. And it becomes sort of a race to the bottom that everybody wants their currency to be at good level, but which bank has to be more aggressive than the others? That is something we all have to keep in mind because the way the dollar specifically moves will have important ramifications on the trajectory of inflation. And with that, folks, we have reached the conclusion of this video. If you happen to be a member of the channel, we already got the market analysis out. I think we covered about 40 charts, so go check that out. But besides that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Jerome, you make something happen now.